Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenivek from Bloomberg Radio.
All right, everybody, we're going to stay with Netflix right now because the stock is down just about 5% here in the aftermarket. Kind of the red stickies, as we like to say, the big headlines at Bloomberg. This was a blowout number. I kind of feel like it shocked all of us. First quarter streaming paid net change in terms of the subscribers up 9.33 million. Tim, the estimate was 4.84 million.
That's not the only beat. First quarter EPS coming at $5.28 per share. Estimates were for $4.52. The company also out with second quarter EPS, the guidance $4.68 versus estimates of $4.54. And then another big headline we should note, they're going to end reporting quarterly membership numbers next year. We got a great group of folks with us right now to help us break down these numbers. Paul Sweeney is co-host of Bloomberg Surveillance. He joins us on the phone from New Jersey. Paul spent 30 years as a media analyst. Also with us is Bloomberg News earnings reporter Red Brown. Hey, Paul, I want to start with you because I got to tell you, I'm pretty surprised by the reaction to these numbers, considering it was such a blowout quarter. Why do you think the stock is moving lower in the after hours?
Yeah, I think it's a little bit buy the rumor, sell the news. People have been hyping up this quarter as a really big quarter because, the paid subscription was going to fuel subscriber growth yet again here. They had a big beat on subs last quarter. So the stock was up about 25% since they reported in January. So it's probably just taking back some of those gains. But, across the board, the subscriber numbers really, really were impressive. One thing to note about the big subscriber beats the last couple of quarters, these are kind of short-term phenomena. As the people that were sharing accounts now are paying for their own, and that'll fade out over the next several quarters. And then the focus will become, I think, on the advertising side of the business as well.
Yeah, it's interesting. Do you care, Paul, to hear that they're going to end reporting quarterly membership numbers next year? Feels like it's something we focus on, yeah. Yeah,
it really is. And that, quite frankly, that had been the primary driver of this stock really since it switched to this digital streaming format. That was the metric that moved the stock. The company really wants to get away from that and get more towards, hey guys, just view us as you would any other company stock. Look at revenue, look at cash flow, look at profitability, all those types of things. And let's focus less on subscriber growth because, quite frankly, we pretty much got everybody that's out there. So it's really not so much a subscriber story. It's more how much money can we make off each subscriber?
Paul, one more to you, and then I want to bring in Red Brown, our earnings reporter, who's been watching these numbers closely. Why would is there any positive way to read into a company like Netflix no longer reporting this? I mean, no question, the more data for investors, the better. This is a negative sign, no?
Oh yeah, I think for an investor and an analyst, you always want more information, particularly when it's critical information in terms of what drives the growth of the business, and it's obviously it's subscribers and how much revenue you generate off each subscriber. It's pretty simple. So when you take one of those data points away, but we've seen other companies in other industries do that, particularly subscriber-based industries. They try to get you away from that number and get you back to look how they are managing the business. And what they're telling you is we're not managing the business to maximize subscriber growth. We're managing the business to maximize revenue and profit per user. That's our management focus. And that's how we look at it, and that's how we think you should look at it.
Red Brown, come on in on it. We talk earnings with you all the time. I'm watching Netflix shares that have been bouncing around in the aftermarket. A lot of moves. Right now, the stock's still lower, down about 3.5%.
Yeah, I mean, I think what might be explaining a little bit of the negative movement, too, is we saw them actually boost their full-year outlook for operating margin. They beat EPS in the first quarter. Their guidance for the second quarter was ahead of estimates as well. But it seems like there's a little bit of a disconnect between the full-year number. If those two pretty healthy beats are not translating to the full year, analysts, investors might start to question maybe where in the back half of the year are things starting to slow down as well. So I think that might also be factoring in here a little bit to the negative price movement we're seeing.
But speak a little bit to what Paul was saying, and I think it's a good point that we talked about it earlier. Just, this stock has been on fire this year, and, it looks like the numbers are pretty upbeat, but it has been such an outperformer this year. And I just do wonder how much of that is at play as well.
Yeah, I mean, if you look at what analysts are rating for the stock, that it's kind of topped out at the analyst ratings point at this point. So, even with these really impressive numbers, maybe it's just kind of hit its ceiling for the time being.
Hey, Red, it's so interesting. I was saying as we were going into our Beyond the Bell, our coverage with TV, as we, waited for these Netflix earnings, I was saying, this could really set the tone for the quarter for a lot of the consumer tech companies that are set to report in the coming weeks. And yet we get a blowout number pretty much across the board, and we see a negative reaction like this. And I'm wondering how we can extrapolate this beyond Netflix. Yeah,
it's a good question. I mean, people have been really focused on earnings this quarter, and a lot of analysts are saying, focus on the numbers, don't buy into the hype, and has really big implications for the stock market in general at the moment. So I don't know if people kind of are on edge and looking for any excuse to sell at the moment. It could paint a pessimistic picture for the remainder of the quarter here, probably for us.
Paul Sweeney, come on back in here. I'm just thinking, we're getting ready for the analyst calls, and I feel like there's going to be a fair amount of questions, especially as you see the stock kind of bouncing around here. What's kind of the top one or two questions that you would want to be putting up on that call?
Yeah, one revenue and one cost question. The revenue side is, talk to us about the advertising component. How well is that catching on with subscribers? How many subscribers are going to the advertising tier? And that's a big thing, because that's going to be one of the drivers going forward. And then the second one on the cost side is, where are we on our programming budget? Do you need to spend more to drive more subscriber growth, or is a company at a good level of spend? Because if they are at a good level of spend, boy, the profits just really start churning for this company, and the free cash flow as well.
I do want to bring in some of the advertising information that you mentioned, Paul. In the letter, the company did come out and say that ads membership grew 65% quarter on quarter after rising nearly 70% sequentially in each of Q3 23 and Q4 23. They're also saying that over 40% of all signups in our ads markets, remember it's not fully rolled out, are coming from our ads plan. For advertisers, the company's focusing on measurement solutions, including new partnerships with Kantar and Lucid for brand awareness and recall, and then Nielsen Catalina solutions for sales lift. Paul, I don't have to tell you, because you've been covering this for years. How wild is it for us to talk about Netflix and measurement? Because this is a company that for years was like, we don't care about ratings. We're never going to share any numbers. We're never going to do ads. Never, never, never. And here they are talking about Nielsen?
Yeah, exactly.
This is crazy.
It is. It's a great point. They're going to have to start disclosing audience levels to some degree. But we already know that the advertising video on demand model is a very successful model. Advertisers are switching from linear TV, broadcast, and cable to the more digital platforms. And they've been itching to get to the streaming base of Netflix. So there will be a lot of advertiser demand. And, Netflix is going to have to provide the advertisers and their agencies with some data, because just so they can just get a sense of pricing and value.
Yeah, and the other thing is I'm thinking about content, right? Original content versus licensing. And when we were talking with Geetha Ranganathan earlier, she said, one of the upsides is that they are, doing a lot of licensing deals. They had Suits. They just did something with Sex and the City. That's just coming out. I mean, when you think about it, Paul, as an analyst and somebody who understands the space, I mean, cheaper to do a licensing deal versus creating that original content?
It is, generally speaking, it is much cheaper to license a show than to create it, particularly the shows that they make, which are extraordinarily high quality, and they have very big budgets. Now, that's the investment part. The good news is it does drive subscriber growth. So I think most investors would say that's a good investment to make in original programming, but you got to find a balance here. And that's true for the media companies. They have to find a balance on what they license to Netflix and what they keep on their own streaming services.
Red, let's say you had a chance to ask management a question today on the call that's coming up. What do you want to hear about?
Yeah, I mean, we're talking about programming and what's going to be driving growth in the future. I think there's a big question around sports.
Oh, yeah.
What level of investment are they planning on putting in that area? We know it's highly competitive. It's really
expensive.
Crowded. It's very expensive. They are kind of dipping their toe in with some of these combat sports. But yeah, it'll be WWE, the Jake Paul and Mike Tyson fight later this summer. We will want to hear kind of what is their strategy. They've been on the sidelines for a while now, and have they been able to see the mess that sports streaming has been from paying billions and billions of dollars? Do they have a different strategy like they have in so many other cases in the market?
I do wonder too, and I'm just looking at something like a Walt Disney in the aftermarket, and obviously it's not just about streaming; it's just down slightly, down about 0.1% here. Warner Brothers Discovery, same story. I mean, Paul, is there anything that you kind of extrapolate when you look at something like a Netflix, and then what it means for some of the other streaming services that are out there?
I think it's actually all net positive, which is it just shows you the strength of the streaming business model. We now know when you look at Netflix's financials that it can be extraordinarily profitable, generate really high returns. So now the question is, who else can join Netflix with those types of financial metrics? Can Disney do it? Can Warner Brothers Discovery? Can Paramount? That's kind of the question a lot of those investors are asking themselves. But it can be done here if you look at Netflix.
Listen, Paul Sweeney, thank you so much. We so appreciate it. Our own Paul Sweeney, who has covered the media industry and did as a banker for many years, 30 years as a media analyst. So really great to get his insight. We're going to continue with Red Brown. We're also going to roll into it our Geetha Ranganathan, who covers the media space for our Bloomberg Intelligence team. You know, Geetha, you called it on the subscriber numbers,
She
man.
did. She really did. Can you remind everyone what she told us a couple hours ago?
You said it was going to be a much higher number. It is a much higher number. Walk us through the quarter, and why is it that, though, first of all, I'm assuming you're watching the stock in the aftermarket. It's down about 2.6%. It just has been bouncing around a lot. Walk us through the quarter and maybe why you think, should investors be disappointed here?
So absolutely right, Carol. It was a blowout quarter. I think it came in much higher than expected. We were kind of thinking maybe $7 million subscriber ads, net ads range. This was, of course, way above that. But I think what is really kind of causing a little bit of concern here is that they are going to stop reporting subscriber metrics altogether. And that, I think, is coming as a little bit of a disappointment. I mean, Netflix is out and out a subscriber story, or at least it always has been. And so this is kind of going to require a complete change in the mindset of investors, right? This was always such an easy model to follow. You just multiply subscribers by the monthly price that you pay, and you kind of have your whole model. But now they're going to stop reporting subscriber numbers. They're going to stop reporting the average revenue per user. So it's kind of going to it's definitely becoming I would say it's gone from kind of high growth to now more, definitely a very profitable company, but obviously they do seem to be kind of signaling that subscriber growth, that the party is going to be over at some point.
Correct me if I'm wrong, Geetha, but did Netflix used to report churn and then they stopped reporting churn? And that was a really big deal to investors when that happened? That
was a very, very long time ago. Yes, they did. They would mention it, and they did stop reporting it. But subscribers, again, this is the bread and butter of this whole streaming business. So I think it's definitely going to require, people are going to take some time to kind of digest that.
Geetha, we've seen they have started to give us a little bit more viewership information over the past year or so. Yeah. Do you think that is part of, or them kind of trying to signal that, ads are going to become a bigger part of our business? And, how big of a part of their business do you think that will be in the next couple of years?
Yeah, so right now they haven't really given us any concrete metrics around advertising. I mean, other than the first number that they gave us in January, which was roughly about 25 million active users. They did report something today by saying, that they've seen like 40% of their new signups are actually on the ad tier, but we don't actually have a concrete number. That said, I think what they're doing, they're still kind of taking a pretty measured approach. But there are signals that they really are looking to get or to scale up their advertising business. And I think sports is obviously a big way that they're going to do that. We obviously saw the WWE deal. There are a few more things that are out there on the horizon, obviously the NBA being a big one. And if they make an aggressive bid for that, then that really tells us how serious they are about advertising. And I think potentially what we're looking at in terms of advertising dollars, if they get everything right, it has been a little bit underwhelming so far. But if they're able to execute with the sports and the other live events, expect it to be at least 10 to 15% of their revenue by 2025. So, you're looking at a $45 billion business. I think you're going to see $4 to $5 billion at least in advertising.
It is kind of interesting. And, Geetha, we all kind of kid. It's like, I only have so many hours to watch all this stuff. And so we're picking and choosing. And it seems like there's so much out there. I mean, the company said in their letter to shareholders, with more than 2 people per household on average, we have an audience of over 500 million. And then they go on to say no entertainment company has ever programmed at this scale and with this ambition before. But it does feel like, and listening to you talk about, them not reporting their quarterly membership numbers in the future, that they are conceding that there is just a point that we're going to max out. We can just only sign up so many people. And that means even on a global scale, right?
Yes, on a global scale. So back in the day, maybe even about 3-4 years ago, they would always talk about this 1 billion number as their total addressable market. About 2 years ago, that's when the great Netflix reset and the great correction happened. They kind of toned that down. They said, it's probably closer to about 500 million as the total addressable market. Looks like it's, probably even slightly smaller than that, So they definitely are conceding that there is an upper limit. There is a ceiling to kind of the growth here.
But is there something like, I always laugh about this sometimes when we talk about some of these big tech names. We used to talk about this a lot by Apple. We'd be like, oh, it's a disappointing number. Yet they still sell a lot of stuff. And I understand its growth trends and trajectory. Can we still, though, concede that Netflix still is kind of the big behemoth in this space?
They absolutely are. They have completely cemented their dominance when it comes to this whole streaming wars. I mean, I think the streaming wars are pretty much over. They are the winner. There's no doubt about that. And now it's just about them kind of, getting into different verticals, kind of becoming that one service. They probably will, kind of absorb a lot of the other smaller streaming services, I think, just because they're licensing so much of content from them. And they, it's just, but at this point, it's definitely going to become, how much pricing power do they have? So right now we are at about $15.50 for a standard plan in the US. How much upside is there? Can that go to $20, $25?
Yeah.
That is kind of the big question.
So it's funny, as you're saying this, I'm thinking to myself, okay, well, 20 years ago, all we wanted was a la carte options for TV, and we kind of got that now. And I think a lot of us are spending more on all the combination of all these services, given that, it's Paramount, it's Hulu, it's Max, it's Disney Plus, it's Netflix, just to name a few. I do wonder, Geetha, where the growth is for Netflix at this point. Is it in the ad-supported model? Is it outside of the United States? Where is that growth coming from as the company matures? Is it raising prices?
Yeah, it's actually, Tim, it's all of the above. And it's just, it's going to be it's a very tough balancing act for them, because they don't want to do anything too quickly and too rashly, which is why when they were kind of implementing their whole password sharing crackdown, they were very careful not to raise prices, because, they didn't want to anger, existing customers. So again, it's going to be tricky. They're kind of walking a tightrope here, but yeah, they are going to use all the different levers that they have to kind of keep profitability, which is their main metric right now, profitability and margins kind of climbing up.
Geetha, before the report and the analysts I was speaking to, a lot of them made a big deal about the T-Mobile partnership that they were working on. How do you see that factoring into the future? Do you think that has been a successful program, and can you expect to see them maybe do some more types of those partnerships?
Absolutely. I think that is going to become a critical factor for Netflix if it really kind of wants to grow its subscribers. So what they did with T-Mobile was kind of, they're offering their ad-supported plan, which is the $7 monthly plan to select T-Mobile members for free, and they're going to do a lot more of that. The having a low-priced plan kind of really gives them a lot of flexibility, because they can add subscribers, but then again, they're not necessarily losing ARPU, because remember, the greater the subscribers they have, they can always kind of appeal to the advertising community, so and kind of make up or offset for any of that ARPU differential from their advertising dollars. So I think that's going to definitely play a much bigger role, not just in the US, but of course across the world as well. They're going to have lots of those kinds of telecom partnerships.
Geetha, what do we kind of pull from this when it means to like Disney streaming and Warner Brothers Discovery and some of the other services that are out there?
So for all of those other services, I think subscriber growth is not the primary focus anymore. It's kind of moved now, Carol, to profitability, where obviously, again, Netflix leads the pack. A lot of these other services have made good progress, I would say really good progress when it comes to at least they're not profitable yet, but they're moderating their losses. Disney obviously is the big one to watch for there, and now they have the model in place. You've seen exactly what Netflix has accomplished. They all know exactly what they have to do. It's just going to be a question of how well they do it and can they get there quick enough.
Geetha, do you think there's any consumer confusion? I mean, okay, I know the answer to this is yes, and I just don't know how to solve it. The consumer confusion about where to watch something.
Yes.
You mentioned Sex and the City, and I was shocked to hear that that's on Netflix. It's an HBO show. Somebody in our simulcast chat mentioned The Office. Well, I think that's now on Peacock, but it was on Netflix. Friends, a former NBC show, or no, Seinfeld is now on Netflix, I believe.
It's confusing, see?
Right? Is that right? I don't know.
It is.
How
Discovery is the big. It's not content
talk
anymore.
about
It's
this.
really just Discovery is the biggest problem right now in the whole of the streaming space. And at the end of the day, we're kind of looking for that one or what we're waiting for is that one aggregator or re-aggregator that can kind of take all the shows that you really want to watch and do it. I don't know who it's going to be. Is it going to be YouTube? Maybe it is. It could be Amazon. It could be Apple. But we're all waiting for that. Again, not sure when exactly it's going to happen.
Roku does a really good job of that, but you got to be signed into everything on your Roku, and plus that means you're only watching on TV. You're not watching it on the iPad or on your phone.
Well, I know
there still is friction.
Yeah, there is still a lot of friction.
Final thought, Geetha. I'm just thinking of our investor audience as we work through this. Netflix shares still down about 3.25% here.
Yeah, so I think the big question is really going to be, on the call, how many subscribers or how many, subscribers do you think you've captured from the whole password sharing initiative? I think the number that they originally identified was 100 million households. I think people will definitely want to know what percentage of that has already been kind of captured, just given the strong subscriber metrics, and then they'll kind of try to figure out how much more runway is left.
Rockstar, as always. Geetha Ranganathan, thank you so much. Tech and media analyst at Bloomberg Intelligence. Red Brown, final thoughts for you, just 20 seconds here. I mean, stock's down in the aftermarket, but we'll see what happens tomorrow.
Yeah, we'll see what happens tomorrow. And for the remainder of the year, I think, they put up strong financials and that could easily bounce back. There's a quick reaction, but investors love the short term.
It also depends on what they say on the call.
Exactly. And it'll be interesting to do if some investors might say, well, wait, it's a little bit cheaper than it was. And I want the exposure. Red Brown, thank you so much.
Also a rock star, Red Brown.
Yes,
Thank
indeed.
you for sticking with us.
It's kind of a rock group here right now.
Yeah, we had a great group.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So the overall equity trade, it is lower on this Thursday. So too, though, is the Philadelphia Semiconductor Index. It has dropped more than 10%, folks, since March 7th. So an official technical correction, if you will, and that has caught our attention.
Meantime, a giant in the space just selling off. Shares of TSMC, Taiwan Semiconductor Manufacturing, down about 4.5% right now. This as it scaled back its outlook for a chip market expansion, Carol, cautioning that the smartphone and PC markets still remain weak.
Yeah, I feel like we're all on notice. All right, let's get more on the group. Let's bring in Bloomberg News Managing Editor of Technology and Global Security. She's Lynn Doan, and she joins us here in studio. All right, Lynn, let's start with TSMC. Investors definitely not happy with the results. It's the world's largest maker of advanced chips, cutting its expectations for 2024 market growth. It sounds like bad news. How do you read it? What does it really mean?
Yeah, I mean, it does put us on notice, right? We're just starting to see the chips companies report. You got Intel next week, possibly Texas Instruments too. And so this is like a potential sign of what's to come in the coming weeks. It's a nuanced picture, though, right? The outlook was bad. It was definitively bad. They were talking about weakness in the PC market, weakness in the smartphone market. But that really outshadowed a very good beat on revenue outlook, on like potential sales, on the fact that AI has growth. And so like the three of us have been talking about how nuanced the chips recovery and the chips boom from AI has been for a few quarters now. I would say this is like the most nuanced that I've seen it. It's
but
like
investors
on one
are
hand,
beating it up. So
that's right.
Do they have it right,
right.
or do they not have it necessarily right because you say it's nuanced?
It depends on how you feel about AI and whether AI can make up for this ongoing slump in the PC market and in the personal and in the phone market, right?
Yeah.
Like, can AI be enough to save these giant chip companies like Intel and TSMC? Like, that remains to be seen. But it does make you question, how you will see the fortunes of NVIDIA diverge from like TSMC and the others that make, the chips that go into cars and phones and PCs.
And NVIDIA is up about 0.6% today.
Right?
Yeah.
Okay,
there.
more on NVIDIA in just a minute, but first I want to talk a little bit about ASML,
Yes.
because I'm wondering if perhaps some investors might have seen this coming after ASML's results yesterday.
Yeah, I mean, they're both very nuanced pictures, and that's exactly why we brought ASML up in that TSMC story, because this is now the second company that has said, whoa, like we're seeing a bit slower of a market than we thought we were, but is also giving a great outlook. So in ASML's case, there was something like a more than 60% drop in their orders. And that is bearish definitively. And yet most of the story and the narrative around its earnings was like, but don't worry, that's just temporary. AI is going to lift us back up. Demand in all these other chips markets is going to lift us back up. I think it's like a short-term versus long-term picture, right? There's a lull in the short term. People are still drawing down inventory. In ASML's case, they make the chip machinery that makes the chips, right? So they're even further upstream. And if you think about the chip plants that are being built in the US and Germany and across Asia, those have a long lead time. So what they're banking on is that, yes, while we're working through inventory now, there will be a boom in the coming years as construction gets away.
Well, as long as there's demand on the other side, ultimately
Right.
the end users, right? Because, I mean, it's great. Like, and let's go to the money that's being put in. We have Bloomberg News reporting exclusively about Micron Technology. That
$6
they're,
billion.
right, $6 billion. Intel, Taiwan Semi have already, right, or they also are going to accept some loans as part of all of this awards packaging that's coming out. Can we assume you can do a lot of investments? If they build them, will the demand come? Can we assume that demand's going to be there ultimately, or it depends where we are in
That's
the
hard to
cycle?
say, and there has been this narrative around the fact that like the market is underestimating how much data center demand there is actually going to be in AI. We had an executive at a Bloomberg Intelligence AI Summit not too long ago, just a few weeks ago, come up, and he's like at one of the hottest AI data center startups, and he was like, a year ago, we were talking about investments in the billions, and now we're talking tens of billions. Next year, we may be talking exponentially more than that, because that is what AI demand in data centers looks like. But, the TSMC story pointed out that we had today that some analysts are like pouring cold water on that idea and are wondering whether the forecasts will hold up and whether they may actually disappoint. That's a big question mark. It depends on how long the AI hype lasts.
Okay,
right.
so that, I was going to say, brings
Yeah.
us to NVIDIA.
Yeah, go.
Okay, because that company not reporting earnings till next month, the 22nd of next month.
They're always last.
They are, but it gives us lots of time to talk about them ahead
Yeah.
of earnings. Shares are down from all-time highs of $974 just a little bit ago, trading now at $844. In recent weeks, we've seen some companies come out with their own chips to try to compete with NVIDIA. Meta comes to mind, Intel comes to mind. Do these things hold a candle to what NVIDIA can do?
I think NVIDIA is still seen as the leader in the pack, but you have seen these other upstarts challenge them. You have seen some established chip makers. We had one in the office not too long ago that is, coming out with its own chip and its own chip design. I think, the challenge for NVIDIA now and going forward is how do you maintain that first mover advantage and keep it? It's honestly the same challenge that ASML is facing. How do you keep up and ahead of the competition on the chip machines too? Everybody is in this race to advance it. then again, like the to be sure on NVIDIA earnings always is that everybody, every quarter is like, this is going to be the quarter where they disappoint. They can't keep this up for this long. And every quarter they defy expectations. So I think you have to brace yourself for the idea that they may be able to surprise on the upside again.
Lynn, 20 seconds. What's the next focal point for you as you watch this space?
The chip space or the AI space?
Chip space.
The chip space. More spending on the government side.
Okay.
More being allocated. What I'd really love to know is where the rest of the $12 billion in U.S. chips spending goes after Micron. You still got a whole lot of money left, and with the big companies out of the way, you could see a lot of smaller names crowd into that space and make a name for themselves.
Well, as I say always, right? Follow the money, basically. Yeah. All right, Bloomberg News Managing Editor of Technology and Global Security, Lynn. Thank you so much, Lynn Doan, joining us here.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
While sales of previously owned homes in the U.S. fell in March from a one-year high, it underscores the lingering impact of high mortgage rates and elevated prices. Meantime, a great story by Bloomberg's Matt Boesler today on how rents are the Fed's biggest stumbling block when it comes to taming U.S. inflation. The housing market, of course, incredibly important to the economy and investors. And there are cross currents out there for sure.
Yeah, which is why we knew we wanted to check in once again with Kate Kaminski. She's Chief Operating Officer of the privately owned and asset and real estate investment company, Walton Global. They've got about $3.3 billion in assets under management, over 90,000 acres under management here in the United States. She's with us once again from Scottsdale, Arizona. Kate, good to have you back. How are you?
I'm great. How are you doing?
Doing well. Trying to keep up with everything that's coming up, and it sometimes feels cross currents are coming at us. Last time we talked, late February, you said pretty excited about 2024. Are you still pretty excited about this year? Are you less excited, more excited? Tell me what's changed since February.
Well, looking at the March numbers that came out, I mean, we've definitely seen things plummet a little bit since we last spoke. We're down about 14% for new home starts. But if you look at it year over year, we're still up 21% year over year. So I would say my sentiment hasn't changed from that perspective because we're still seeing, at least for Walton's business, where we really focus in delivering land to new home builders. Companies like Horton put out their earnings today, and I mean they just had one of their strongest quarters ever, and so their stock's up. I think home builder sentiment's up. There's definitely headwinds with what we're seeing with inflation creeping up, mortgage rates creeping up. I think they went over 7 today. So we've got to get that under control. But we remain bullish on the outlook in the new home building space, most definitely.
So what happens if rates don't go down? What happens to your business over the next year, Kate? I mean, there's been lots of talk this year, just in the last few weeks, actually, and a lot in the last few days, that the Fed may not even lower interest rates this year. What does that mean for your business at Walton Global?
Yeah, I mean, we're reading the same economic data points and preparing for the fact that there may not be any rate cuts. We certainly hope that there will be, but especially given it's an election year, I think we're all we have to keep our seatbelt on and go along for this ride. But with that, we're continuing to hold steady in terms of transactions, and think that this is actually going to catapult forward additional transactions for Walton's business, because what we focus on is providing future land supply to the new home building space. And really we do that through a just-in-time inventory approach, nothing you haven't heard about or we haven't talked about before, whereby the builders are not paying for that land today, they're paying for it in the future. And with Walton's approach, it's when they're actually selling a home to a third party. But so as builders continue to look to preserve cash that they have on hand today, I think that there's going to be even more demand for these unique structures whereby they can defer land buying costs, even development costs. I think we'll start to see a lot more of that over the coming years, and especially this year, so that the builders can take capital that they have on hand, which they have a lot, and use that for things like continuing to buy down mortgage rates, because I don't think that's going to be a program that we see go away anytime soon, because that's how we're going to get buyers into homes.
Right. And as you did say earlier, U.S. home builder sentiment holding at 51 in April. So it came in line with forecasted numbers by the analyst community. That was a little bit earlier in the week. Having said that, right, you guys do buy land and then home builders buy that land. Is there any changes in the types of activity that you are seeing or where they want to be building regionally? We've talked about regional variations with you before and like all of the activity that's happening down south. What can you tell us? And sometimes the information gets a little bit more nuanced and interesting.
Yeah, again, the data that came out on March, it's showing that we saw that decrease in starts from February over March right across the country. So I'm not going to say that there's one region in particular that didn't see some softening from February to March. But again, looking at things, year over year, we're still seeing continued increases, strength in the numbers, which I think is leading to that, home builder sentiment and good performance that we're going to see from these builders in Q1. We continue to be extremely focused on that southern half of the U.S. As we continue to see more companies relocate to these markets, job growth within those markets, and population growth, which is at historic highs. I think that the southern portion of the country is going to continue to be an area that we can really look to for strong results.
Kate, again, to remind everyone of what you guys do, you manage land, you buy it from folks, you manage it, you hold on to it, and then you sell it to the large home builders, some of whom you've already mentioned during our interview. I'm wondering about the other side of the equation, going and acquiring that land right now. What trends are you noticing? Are you able to buy all the land that you want to buy right now? Where are the opportunities? How are prices?
Land prices, like everything, have been rising, and it's getting more and more competitive to buy development-ready land, and that's really the key phrase there. I keep driving home this point as we have these interviews, but we're not seeing anything loosen in terms of restrictions on development ready land across the U.S. Municipalities looking to approve land, and then even more important, the infrastructure injections, spending to get servicing to that land for it to be developed on. But so, all of these factors are making the development-ready land supply even more and more constrained. We've got around 90,000 acres under management. That makes us one of the largest owners of development-ready land in the U.S. But we're continuing to look every week for new acquisition opportunities, because we just think it's going to get tighter and tighter. But so we're certainly advocating for how can we affect change to get land approved, mostly for high density residential development, to get infrastructure spending and approvals,
Right.
so that places like here in Arizona, where we have water challenges, we need to figure that out, because the population continues to grow.
Yeah,
here.
I was going to say how much climate change is impacting kind of all of what you do. Just got about 30 seconds left here. What can you tell us on that? That's certainly something we're thinking a lot about here at Bloomberg, and got our Earth Day coming up on Monday, so kind of thinking about that too. How is that complicating the situation? And again, just got about 20 seconds.
Yeah, it's huge. Florida just put some moratoriums on development to really figure out what's happening with wetlands in Florida, and so I would say that it's really region specific and the environmental impact within those markets. But there's a compromise here, and I think we need the government to work with the builders and developers and landowners to figure that out.
Got to run. Kate, thank you so much. Kate Kaminski, COO of Walton Global.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Can I say this on the radio, Carol?
Well, I don't know.
Okay.
You can always say it once.
The rent, as they say, is too damn high and still increasing too fast.
You're still here.
Okay, I'm still here. Here's
Said
what
it
we
twice.
mean. Here's what we mean, okay?
Yeah.
When inflation peaked above 7% back in 2022, it was relatively broad-based across goods and services. In 2024, with inflation back below 3%, it's no longer the case. What's left of the problem is now mainly about housing.
Interesting. In the new issue of Bloomberg Businessweek, Matt Boesler and Jennifer Epstein write about the Fed's biggest stumbling block in taming U.S. inflation. Matt is Bloomberg News U.S. economy reporter. He joins us here in our Bloomberg Interactive Broker studio. Really timely story, makes so sense, and we've talked so much about kind of what makes inflation sticky. Lay it all out for us and what you found in your reporting.
Yeah, so, we're used to kind of hyperventilating around the monthly inflation numbers when they come out every month, and the story's always like, oh, what happened with goods prices? They're falling, or, oh, core services is looking hot. That must mean the labor market's too tight, and so on and so forth. But the truth is, if you really look at the numbers, like the kind of big underlying component that determines the trend of the overall inflation index always comes back to rental inflation. And so we're in a situation now where not only is that usually the most important, but it's especially the most important right now because it's also the component of inflation that has been slowest to come down compared to goods and services and food and energy. And so if you start to dig into those numbers, what's going on there, it looks really interesting on a regional basis where you're seeing very high rental inflation still in like the Northeast and the Midwest. It's actually coming down very quickly in the West and the South, where in a lot of those cities, they've been building a lot of housing over the last few years.
Go figure.
Yeah, it's
you increase supply and prices come down. Hold
Welcome
on,
to
Matt.
Eco
I want to make sure I
101.
get this right. Supply and demand.
Supply and demand.
Okay, so it actually brings me to a serious point because the Fed chair has been asked about this several times over the last couple of years, probably more than several. You follow kind of everything he has to say, but he doesn't have control over zoning. He doesn't have control over where homes are built. The Fed really has a limited toolkit when it comes to this stuff. So what can the Fed do to tackle rent inflation?
Well, that's a really tricky question because typically the way they think about it is, okay, if we raise interest rates, that will reduce demand in the economy, which will reduce demand for housing overall because people have less money to spend on things like housing. But the problem is with housing in particular, sort of that relationship between interest rates and rental inflation, kind of the sign on that relationship, whether it's a positive or negative correlation, can be a little ambiguous because there's also reasons to think that, oh, maybe higher interest rates might not be great for housing supply, right? If you're trying to finance construction of housing.
We just talked about that with our guest in the last hour, but go ahead.
Right. And so there's things like that. I think most people still believe that on net, the effect is that you raise interest rates and that's going to slow housing on the margin. But it's a lot harder to kind of make that case versus some other more clear-cut kind of components of the inflation index where it makes more sense.
What actually makes up the rent component specifically? Is it rental, any kind of housing? Like, just break it down for me.
Yeah, so it's mostly multifamily housing. There's also a lot of single-family detached housing that is on the rental market. And so this has been kind of a story lately with some of the drama around the inflation numbers over the last few months and some of these emails that the BLS has been sending out to quote unquote super users and so on and so forth. Part of the problem with trying to figure out what exactly is going on is that the BLS doesn't publish the weight of single family versus multifamily housing in the index. So you kind of have to guess.
Because I guess just for a moment, I just think about higher rate environment, you can't afford to buy a home, right? Because the mortgage rates are higher. So you end up renting more and that just drives up rental prices even more. It's as simple as that, is it? Or somewhat?
Well, I mean, so that's part of the reason why it's not clear that raising interest rates will reduce housing demand, because that's one of the big countervailing effects that people, speculate about. There's another kind of more interesting component of this interest rates and rental inflation conversation, which has to do with like the way that the CPI numbers are constructed in particular, which is that We've been talking a lot about these measures of market rents on new leases, right? From Zillow Group, or the BLS is even publishing their own now. And those show that rental inflation has either slowed a lot, or rents are outright declining in a lot of places. Mm-hmm. The problem is the CPI numbers measure the average rents for all tenants. And I think it's something like 90% of tenants don't move in a given year. And so the CPI numbers are dominated by people who aren't moving. And so it takes some time for, those market rents to get into the kind of like average rents. And one theory that we talk about in the story a little bit is that high interest rates may be affecting the amount of time it takes for market rents to get into the average rent figures, because there's just less turnover. And so the housing stock's turning over less, and therefore, those market rents aren't being reflected in the full housing stock as quickly.
I don't mean to ask a question that involves moving goalposts, but Carol and I do talk a lot about a 2% inflation goal and whether or not that is something that needs to be revisited. I think there are a lot of questions about that.
No yet.
But what about just stripping out? What happens when you strip out housing and so-called supercore? Because it actually is pretty significant, and now some analysts are stripping that out when they look at how inflation is moving.
Yeah, so if you do that, inflation is basically back very close to 2%. This housing thing is really like the last, big remaining piece of the issue. If we were stripping out housing, on the core PCE indicator that the Fed likes to look at, we'd be talking about more like 2.2, 2.3% inflation. And you can imagine the conversation would be very different given that we have 5.5% interest rates.
Really different. 30 seconds left. Wrapping up, I'm just thinking about folks who are listening to us and watching us right now. What do you think is it that they have to kind of take away from this as they think about either the investment environment or ultimately what the Fed can or can't do based on this data?
So I think the big thing is to, keep an eye on the rental inflation numbers when we're looking at the monthly inflation statistics in particular. And, think about kind of what's going to get us down back to kind of pre-pandemic run rate for those rental inflation numbers. A lot of people are forecasting that that's going to happen any month now. They've been saying that for a couple months, so we'll just have to see. But if that does happen in the next couple months, then the inflation conversation could change again pretty dramatically.
Yeah, which we've seen some big swings in it already.
Exactly.
Did I mention that Matt's story is featured in the forthcoming issue of Businessweek Magazine? It's available now on the Bloomberg terminal. And at Bloomberg.com/Businessweek.
It's a great read. Matt Boesler, U.S. economy reporter at Bloomberg News, here in our Interactive Broker studio. Matt, thank you so much.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just got about 18 minutes left in the trading session. Getting ready to wrap up the trading day and get to those Netflix earnings, which are definitely a focal point after the closing bell. Charlie just breaking down the numbers. A bit of a mixed trade, but lower, in particular on the NASDAQ 100, down about 0.4%. And again, on a day where we've seen some movement in U.S. Treasury yields, although we're off some of our highs. But as Charlie mentioned, looking at the 10-year, 4.63 right now, 2-year net with a yield of 4.98, so just shy of that 5% mark. But keeping an eye on that higher or high for longer.
Well, let's get to our drive to the close. For that, we go to Burns McKinney, portfolio manager at NFJ Investment Group. Burns joining us from Dallas, Texas this afternoon. Burns, how are you?
I'm doing great, thanks. Thanks for having me.
Yeah, it's good to have you with us. What do you make of this rising rate environment? I mean, it's kind of funny for me to say rising rate environment because that's the environment that we've been in for the last 18 to 24 months. But it does seem like investors are a little concerned that the Fed is not going to be cutting this year.
That's definitely been the most prevalent narrative over the last week or so. We've had 3 straight months of stubbornly, difficult to tamp down last mile inflation. And so when you had Jay Powell earlier this week suggest that, really the Fed's in no hurry to cut rates, and suggested that rates might be higher for longer, you saw a convergence between, what investors were thinking and what the Fed had been saying for a while. At the beginning of this year, we were talking, or the market was expecting 6 or 7 rate cuts. And really, calendar to date, we've gone from that to about maybe 1 to 2 rate cuts. Now, the good news is on this front is that we're seeing higher bond yields, but it really it hasn't derailed anything yet. You've still seen, despite the fact we've had a tough week, equities are up this year. It hasn't affected the economy so much. I mean, the jobs reports have been very strong. In fact, what's interesting is that despite the fact that there's a lag in Fed policy, they started hiking rates 2 years ago. And in fact, over the last 24 months, unemployment has been below 4% for over 24 months in a row. The last time we saw a run that long for low unemployment was over 50 years ago. So jobs have been very strong. And really, it buys the Fed time and patience. It's sort of like, if you're on a road trip, if your car's getting a little better mileage than you expected, then maybe you can make it a few more exits before having to take that stop. But what it does mean is higher rates for longer.
I mean, we're just kicking off earnings. We're kind of a little bit on pins and needles awaiting those Netflix results coming up after the close of the bell because they're one of the big mega cap names, right? The tech names that we really kind of follow very closely. Having said that, you've got some names, especially within the value world, that you are finding interesting. Starbucks is among them. What is it about Starbucks that you find interesting at this point? And I'm just pulling it up on the Bloomberg. Stock's down about 9% so far this year. And we're looking at, a forward-looking PE of about 21, but we know that they've been going through some things.
Yeah, we're looking for, again, we're contrarians, and we're looking for the babies that have been thrown out with the bathwater. Starbucks has been lagging of late, and as a result, what you're able to get is a growth name at a reasonable price. You noted that it's trading about 21 times earnings. Over the last decade, it's averaged closer to 30 times earnings. And in fact, outside of that brief run during the pandemic, this is the cheapest Starbucks has been on a PE multiple basis over the last 10 years. So you have that. They've been very generous with shareholders. That their dividend payouts gone up by nearly 20% per year for a 10-year run. That's a great way to keep up with inflation. And in this type of market, pricing power is paramount. And what they sell is they're the dominant player in an addictive product. So they've been able to, as a result of that, consistently grow sales. And I always like to look at stocks that you maybe have a little experience in. When I'm on the road for business, I might stop in there for a brief water. My daughter does her homework there. My son meets up with his friends there. I kind of like to describe Starbucks as the town square of the 21st century.
I mean, that's what Howard Schultz wanted. Like you're like reaching to. This is literally like the thesis of Howard Schultz. The question is, can they do it in a way that not only satisfies customers but also their employees, as they've had the labor challenges over the last couple of years.
Stock hasn't really gone anywhere in the last couple of years, and I feel like I'm gonna mimic or something my husband say. Just because it's on sale doesn't mean it's a good deal. So I'm just saying, right? Unless there's the growth there, how patient do investors need to be?
Well, again, the fact that the margins have been pinched a little bit over the last few quarters, that's one of the reasons why investors do get such a great valuation. And noting the fact that it's not just cheap on a relative basis, this is the cheapest it's been in a decade. And so, when you start off, value is what you get, what you pay for it, and as a result, it just kind of shifts that risk reward to the upside for investors as far as getting an affordable starting point. You've got a company that just efficient operations, same store sales have continued to grow at 3 to 4% per year. It's been very consistent on that front. And again, there's very few companies that have really demonstrated the type of pricing power that they have. And so, especially in an inflationary environment, that's the type of thing we're looking for. That, and as I said, it's growing dividends. In case things do go sideways, they'll pay you to wait.
Hey, what about Crown Castle? This is a company that it's a REIT. They do infrastructure for wireless communications, think cell towers and the like. You're also bullish on Crown Castle. Why?
That's one, again, I think that for one, you just have to kind of bear in mind that, the stock market's actually pricing in a pretty positive scenario. Investors aren't looking to play defense right now. I think, no one's thinking about a recession now the way they were a year ago. And in the case of Crown Castle, they're a REIT. They own cell towers. They pay a consistent 6% dividend yield, which is another great way to play defense. As far as cellular service, basically, it's just a play on the rising demand for digital content. 5G, in fact, is even more profitable for these guys. And it's the type of thing where they sign long-term contracts with their clients and with automatic inflation escalators. And the nice thing for us is we don't have to be smart enough to know which streaming service or which websites are going to be the successful ones. It's kind of that pick and shovel play of the 21st century, whereby regardless, people are going to have to use their cell phones. I was listening to a radio show the other day where someone was hypothetically asked, what would you give up first, your heating and air conditioning or your cell phone? And I'm not to say which side of the coin I'm going to be on that, but the fact that people are even asking that question does indicate that they do sell a very important product.
It depends on where you live. If you live in California, you don't need heat or air conditioning for a lot of the year.
It's an easy ask.
So that's an easy ask. Anywhere else in the country, though, you might have to think twice about that.
Dallas.
Yeah. I can't imagine. I mean, cell phones at this point are kind of almost, I don't want to say they're a utility, but they kind of are.
I think you can say that.
Yeah, no doubt about it.
Yeah.
Burns, thank you so much. Fun to talk a couple of names with you. I really appreciate it. Burns McKinney, he's portfolio manager at NFJ Investment Group, joining us from Dallas, Texas.
He also likes NextEra Energy. We didn't get to talk to him about that. Next time he comes on, we'll chat with him about that. Likes REITs, healthcare, industrials.
Yeah, I'm looking at NextEra. It's going to report next week, guys, before the market on April 23rd. It is up about 6%. It's got a dividend yield of about 3.2%. But it's interesting. We talked about the power grid and energy and utilities a little bit this week. So we'll see what they have to say ultimately.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.